Good morning, good afternoon. Let me know if you can hear me and the document is visible. Okay, looks like I can't hear anyone. All right, thank you for confirming. Good to be back, good to be back. I know we had a gap of a week. I wasn't feeling that great last week, went down with COVID, but tested again yesterday and now I'm negative. So great to be back. Feels so good to be back in my regular location. Was quarantining for almost 10 days. So feels good to be back to our regular schedule. So what's been happening? Any new stuff over the last week? Anything else tried? SPX trading, SPX is going on good. Yeah. So now I move more towards the SPX, basically indexes, SPX, NDX, RUT, instead of doing those ETFs. I think so far so good. Mostly I'm using it for hedging. So from that perspective, if you lose on hedge, that is great because it means the rest of the portfolio is going up. But I find indices as much better instrument than the ETF, just that the notional value is higher. So gotta do the spread. If I go, do a naked call, it consumes a lot of buying power. So I am doing like $50 wide, $100 wide call spread. But purely those are my hedging instruments. So from that perspective, so far so good. We'll see, how that pans out. But those hedging trades are the best ones for this year. Reasons are not surprising. Markets have been choppy for first 6 months. So those hedging and the covered calls have been working out great. Now I realize how many people underestimate the power of covered call. 2020 covered calls. People started to hate covered calls because the market was just going up and up, and they thought it will basically take you out of the market and your stocks get sold. But now, I mean, it's been one of the best trading strategy after the hedging. Covered call has been the second best one. Can you show the buying power of an SPX Iron Condor $50 wide? So if you're doing an Iron Condor $50 wide, the buying power will be 5,000. Because we're already limiting the risk by adding those wings. So the problem becomes when it's a naked, right? So if it's a naked call, let's pick up SPX. Okay, let me just bring that up. Let's see SPX. Okay, let's hold on. Let me share my screen. So say if we bring SPX and let's pick up the next week. I'll pick up the next weekly, which is what, let's say August 5th. If you're trying to sell, say 4,000. Let's pick up 30 delta, close to 30, 30, 30, 30. There we go. Okay, 40, 50. If we try to do that, it's gonna consume the buying power almost 48,000. So that's a problem. So instead of doing, I mean, in case of SPY, it was okay, SPY or IWM or RU, those ETFs, it's easier to do naked calls because the buying power consumption will be very less. But in this case, one contract will basically selling a 30 delta call on one contract will consume $48,000 of buying power, which is used. I don't want to block 48,000 for this individual trade. So what I started doing was instead of doing the call, naked call, maybe do a $50 wide or $100 wide call spread, with which then you you do reduce your premium by a little bit. So instead of 25K, I have to now give up all instead of $25, I have to give up $6 to buying this protection, but then it will limit the buying power to 10K.
Might as well just sell an NQ naked put for the end of the year to 7,000, 8,000. You talk about the same amount of money for the same, actually a slightly better return, right? I mean, I see a lot of people doing SPX. I just don't get it. The buying power effect is so much, and you get so little money in return.
Yeah, so that's all right. Now, if you look at it, instead of I generally use I'm starting to use this SPX etc. more from hedging. So selling call spreads just to reduce the delta. I think in my retirement account I have SPY as an ETF holding. But so on my option side account, I just use SPX just to manage the delta on overall delta on my portfolio. I don't have any other use for
just to hedging.
Just for hedging, yeah. Because I mean, I have a lot of other stocks in my portfolio. So if you look at,
why don't you just buy puts on SPY? That will give you
Right? So today we're gonna talk about one of the topic that I have again a recent study is around portfolio protection, and over the years buying put doesn't work out. So that is why I'm for portfolio protection I never bought puts. So I generally sell calls. Used to sell naked calls on SPY, but now moved to SPX because of a tax efficiency. So now I'm converting, instead of saying naked call, which will consume a lot of buying power, I'll rather sell a call spread, and I'm comfortable in managing my risk, etc. So I don't think I've ever bought put.
You must be making billions in a bear market. Good for you, Vivek.
No, the hedging has been, so let me put it this way. This year, just the hedging trades have returned almost 15% of a portfolio value. It's a different matter that my long positions are down, but the hedging trades have worked out really nice. But again, those are hedges, right? Not intended to make money, but yeah. So in this case, now I'm blocking what max of 10K, subtract this premiums, almost 8,000 getting blocked with a potential to make $1,800, which is great. So, and if I lose on this, it's okay because the rest of the portfolio has gone up.
So Vivek, this is a portfolio margin. So the portfolio margin does not help in reducing the buying power. It's still 10,000.
If you do what do you call iron condor, or if you do a spread, then the portfolio margin doesn't have.
Okay.
But if you do a naked one, portfolio margin does have.
Okay.
Right. So if I do a naked one, if I don't have portfolio margin, this will be almost like $400,000. Right. So, but if I do a naked one, capital block for me is $48,000. Right. So, which is still, it helps from a portfolio having a portfolio margin, but still $48,000 is too big. So that is why if I'm focused on SP. So let's look at my.
I actually tested. It's 70,000 on mine, and it's 48,000 on yours on the naked.
So let's say this one was right. I started with a call spread and then just added a put spread because my deltas last week the market going really high. I lost a lot of deltas, so I wanted to add a little more delta, so converted it into iron condor, right? So, but for my August, I just had this call spread as a delta hedging. So that's how I use SPX. Yeah, so in 70,000 could be because of your portfolio. The margin is maybe a regular recti margin. You know,
Yes, yes.
Okay, yeah. So on a portfolio margin, you get a little more benefit. So, but still, 48,000 still a much bigger amount.
Yes, yes.
So
okay, so yeah, I was just wondering if they cut down on spreads too, but I guess not.
no, that's little weird. And sometimes I've seen that. You know, I think in portfolio margin it's still okay, but you know, recti margin, say if you do these two trades separately, say you sold a put and then you bought a put later on to convert into a spread, even though on your analyzed graph you will see it as a spread, the broker will still consider them as a two separate trades, and you don't get the benefit you know, of a reduction in buying power. I had seen this earlier when I had my recti margin account. I'm like, I bought a put, why it's not reducing the buying power? Weird, isn't it?
Yeah, I've
They
seen
consider
that.
them as two separate trades.
If you have a spread on one side and if you have a naked put on the other side, for example, it does consider them separate, and it doesn't give you the benefit.
Right.
Yeah.
So, but on portfolio margin, it actually looks at an overall portfolio and not as an individual trade.
Yes, yes.
So then you do get the benefit of that. Yeah. I mean, you should apply for portfolio margin. You have to get through one test though.
Yeah, I look, it's a pretty simple test, so I'll do it.
Yeah. It helps. Not that I'm going to use all the buying power available because I've been a little conservative or cautious options when it comes to options, so that I don't have to worry about margin calls or anything like that. But it's good to have that availability in, you know, in your back pocket.
Hey Vivek, so with the SPX trading right there, I have heard some horror stories about, you know, the expirations, and a lot of the people in the other group I was in, they play the 0 day to expiration, and that can get very scary when things go sour or go you know. But are the options in the SPX, are they mostly AM or PM settle?
There are, I think, both. The one which I initially did those were AM settled, so which is a little scary because you don't know when the market will open. So what I did was to close it on Thursday evening itself, right? Not let it go on Friday morning.
Well, if it's a Friday expiration, actually, you have to close it up by Thursday, right? Afternoon, right?
No,
Yeah,
you don't have to close it.
Yeah, because otherwise on a Friday morning, you don't know where it will open. And so what will be the expiration price that, you know, it will pick up. So you better close it on Thursday. And I think that would apply to not just from my perspective. I use this strategy not to let it go into expiration if it is closer to my you know, break even or closer to my strike price. I would rather close it prior and not worry about expiration. But that I follow even for the regular options also, not just SPX. And it's always a good strategy to pay, especially if you are selling, to pay a few pennies, and you know, don't have to take a mental tension of once the market is closed, what happens in after you know, after market movement. Any stocks could move, and then if you're not watching it, we have seen those horror stories of what it could cause.
Yeah, I think spread is fine. If you do naked, that gets very, very scary very, very soon, you know.
Exactly. Yeah, so far SPX and NDX, they are okay. I just want to reduce, you know, become more efficient in terms of tax perspective. That's why I thought, okay, let's let's dip my toes into indexes.
Yeah, I haven't really traded SPX. Mostly, I trade a lot of SPY, QQQ, but I'm scalping, right?
Oh, okay.
I buy the money, puts in calls, and I get out very quickly, right? Yeah.
Something, doesn't work for me though. But yeah, mine is mostly hedging
Mhm.
because I hold SPY on my retirement. Plus, anyway, I mean, I have a lot of individual stocks. So I shared that pizza a few weeks ago, and next month we'll also share it. So, but now I think the overall count has come down closer to 75, but still too big. So yeah, these are my hedging instruments.
75 positions?
75 individual tickers across all my portfolios, 401ks, long portfolio options, etc. Everything. So
Yeah, I used to have 180 positions, options positions. I brought it down to about 100, but my goal is 20.
I have these tickers. Then option positions, I don't count. Anytime 70, 80 option trades might be open, but I just want to reduce the overall number of tickers that I hold in portfolio. So I started this year with 105 or 106, somewhere like that, between 105 to 110. So brought it down to 75. End of a year, I should be getting closer to 60. I'll achieve my target.
Yeah.
Yep. All right. Anything else? Anyone has tried anything new? So my story is around trying with indexes.
Well, I tell you, man, I this is kind of interesting. I recently stumbled across the YouTube video on the market maker weekly cycle, right?
Mm-hmm.
So there's a weekly cycle per se, so what a market maker does is they need liquidity, right? They're in the business of buying and selling, right? So they need to sell and they buy all the time. And there is a template, right? From Monday to Friday or Monday to Sunday, there's a template. So I'm actually just looking up on YouTube. It's very interesting, right? So now I'm trying to find a pattern, right? I was going back in 3 or 4 weeks, and I see every Thursday a green, right? And I actually predicted Friday, like yesterday, is a down day, and I'm thinking Sunday they're gonna pump it back up because the FOMC, they're gonna pump it up and then they're gonna dump it, right? But I don't know whether or not you have you know about this and have looked into it before.
No, I've heard about a lot of people trying to figure out how the market makers are able to, how the market gets impacted by the actions of market maker. But from my perspective, I'm a little more purist, is markets are efficient. Market makers generally will stay delta neutral. So I don't think whether they are intentionally trying to push the market. I don't think so. But yeah, people are trying to find patterns and trying to figure out if we can get ahead or predict how the market is going to behave by the actions of market maker and try to profit from it. Go ahead. I mean, I just don't have a time and on trying to figure that out.
But actually,
one day when I become full time into this and don't have to worry, don't have another job, then maybe I can dig deeper into trying to do these things. For now,
you spend more time in research than I do.
So for now, I want to keep my investing life little simple because I can't track markets. I can't sit on the screens for the whole day. Especially last week was because I was down with COVID. I had whatever time I had, I was just working for office. I'll basically work for 3 hours and then lie down for another an hour. Man, COVID just exhausts you.
I don't think it seems like everybody's getting COVID, man.
Yeah. So I went down. I mean, my regular symptoms were not bad, but the only thing is I get tired too soon. But I tested again yesterday evening and I tested negative. So I told my family, can I now come out? Is this my get out of jail card? They said, yes, now you can come out.
Wow.
So, yeah. So that's why last week I had to cancel it because I went down on Wednesday with COVID. So
I actually signed in last week. Hey, what happened? Maybe you had a vacation day.
No, I was just sick. Yeah. Couldn't prepare anything. I hadn't done anything and I don't want to, come and not have anything to talk about. I don't want to be respectful for all the people who join here, want to be respectful of your time. So I wasn't prepared at all. So I had to cancel it. Cool. SP says, by the time you figure it out, market makers will change it. Yeah. Cool. All right. So let's get going for starting today. We want to talk about, it's an earnings season. We had Tesla and Snap, at least two companies. I looked at their earnings. So we're going to talk about that earnings. Also want to spend a little time on what's happening in China. We don't see a lot of news around China because obviously a lot of China government, they also censor the media, but things that I read about doesn't look good. And lastly, I'll go through a new research from Tastytrade around the cost of insurance, right? There was a question on that. Why don't you buy a put if you want to just get a protection? I think earlier I had shared multiple studies by Tastytrade. Also, we shared a research done by an institute in Europe with looking at the data of almost 30 years on what kind of a portfolio protection strategies work. Even in that one, buying put was the worst portfolio protection strategies over long term. So yeah, we'll look into one of that research report which came out last week. With that, let's get into today's session. Everything that we talk here is only for education or entertainment. I don't have to tell you that again. I am not a financial advisor. I am a regular guy working in a tech company, and investing is my passion. So want to talk about it, want to learn from you guys. So yeah, as always, if you have a question, put it in the chat or you can unmute yourself and we can have some good discussions. So at a macro level, investors actually welcome slowing economy. I mean, there were many signals that the economy is slowing down, but the markets were great. The week that just went by, market was green. Even prior week also, we're seeing some optimism in investors, right? Except Friday, because on Thursday we got results from Snap, and that spooked a lot of social media companies. But prior to that, let's look at SPY or SPX. It was around, say, 3,700 to almost 4,000. So had a pretty good week last week, and investors are welcoming the signs of slowing economy, because it means if the economy slows down, the Fed may pivot sooner than we expect. Right? So far, Fed has been tightening. The whole idea is if we start to feel pressure in economy, sorry, Fed may just pivot and will not tighten it as much as what we are thinking. So that will, this is the times of, it's a strange times that something bad for economy is good for the market. So we saw small caps, we saw NASDAQ, they outperformed generally the defensive sectors like healthcare, utilities, consumer staples. Those are generally considered as defensive. Those didn't work as good as some of these small caps and the NASDAQ. So risk on, very risk on. People became a little more comfortable in taking risks, but we'll have to see how long can this continue. So consumer discretionary had outperformed. Look at what Amazon and Tesla, both of them had some good moves. Tesla, in fact, was flat just after earnings in the aftermarket. Immediately after earnings were announced, Tesla went up, came back down. Next day, it opened higher. And all this is happening while some of the market gurus, and we'll talk about BOFA, they're predicting that worse is yet to come. Market hasn't bottomed out, right? Smart money is still sitting on the highest level of cash. So there was a survey conducted by Bank of America of all the fund managers. They are sitting on tons and tons of cash, not yet invested in market because they think that the bottom is not yet in. It also showed that the fund's cash holding has reached their highest level since 9/11. Over the last few weeks, the lot of optimism has been driven by retail investors and not by institutional investors. So institutional investors are still in hold and watch mode, but retail investors are getting back into the market, thinking the bottom is in. The fund manager equity exposure were the lowest levels since the recession and the global financial crisis of 2007 to 2009. So not a great picture if you look at and think, okay, institutions know what they are doing. What else last week? Earnings is here. Netflix is up 25% in a week. They lost subscribers, but they lost fewer than what market had predicted, right? So less bad is good now. Very different situation than what it was during the start of June, wherein even a good is bad. You have to be great just to keep your stock at the same level. Any news which is even good, market would just discount it and the shares to get plummeted. But now even the less bad is now considered good. And then Snap, we talked about it. Excuse me. Its results on Thursday, they spooked the markets. Snap had already come and told the market a month ago that they're not gonna meet their forecast for Q2, and eventually that's what it happened. And I think what spooked the markets were more around, this is going to be almost a flat year. So anything that is dependent on ad business, Facebook's, Google's of the world, they all got good beating on Friday. Economy, this is where we are seeing some signs of slowing economy. Weekless jobs claims were higher than expected. Manufacturing fell to its lowest level since early pandemic. Housing data generally disappointed, with housing starts and existing wholesales are missing consensus expectations. So, but slowing economy, good. Short term, good for the market. So we saw markets really green candle in the market for the week. What else? BOFA. So Savita Subramanian, she's very well-respected analyst from BOFA. When she talks, CNBC will give a lot of coverage to her. And I don't know which day was it, but she slashed her price on S&P from to 3,600 by end of year. It was 4,500, right? And the floor is around 3,000 to 3,200 before the year end. Don't know, but I have heard that maybe October is generally the very bad months for the markets. The big crash of 1987 also happened in October. So some pundits are predicting we may see a good month in August, September, just to crash again in October. I have no idea of what will happen. Some of these predictions may come true, may not come true in one or the other year, but Savita reduced her flow to almost 3,200. So we did see little concern, but I think markets took it in its own stride. So we'll see. So their forecast still implies 5% drop in the market through the end of a year. But the forecasts are forecasts. No one has a crystal ball. So how did the major indices do by end of this week? We are still way down, right? It's still down 17%. S&P 500 is still down year to date 17%. NASDAQ is closer to 24%. So let's see how the second half looks like. I don't know if we'll be able to close in, even if we are able to close in positive or neutral, that's going to be great. We are more than half, more than half of the year and are still down close to 17%. From a sector perspective, for the last week, everything was in green. The best was, consumer discretionary. They performed best. And yeah, that's on overall macro side. Next week, because the big companies are reporting earnings, I think it's going to be fun on Wednesdays and Thursday. Where does Apple report? From the big ones with the big market cap companies. So Alphabet is on Tuesday. Microsoft is on Tuesday. Then Meta or Facebook is on Wednesday, and then Amazon, Apple is on Thursday. Yeah, there we go, Apple. So we're gonna have a lot of fun next week. It'll determine, how the market could behave. Expect it to volatile because it's earnings season. Right?
Do you think that because in Q1 they set a low expectation, right? So this time around it's going to be easy for them to beat.
So I think it's all going to be about the guidance. I mean, whatever happened in Q2 probably won't impact the results, impact the share as much as what their future guidance could be. And
look at Netflix, right? I mean, that was a surprise. Netflix was like completely went north, right?
Yeah, not because they told that they expect to, obviously they lost fewer than what the market was expecting. So they actually lost subscribers in this quarter, but fewer than what the market was expecting. But what helped Netflix was the guidance that they gave that they're going to increase the subscribers by the year end. So I think, again, it probably is going to be more about the future guidance than the quarter, how it actually did in this particular quarter.
So guidance for tech companies in general probably not going to be good, right? Because they have all stipulated a hiring freeze, right?
They have hiring freeze. I don't know. I mean, we'll have to see what each of the companies come and talk about it. Yeah, so Google had announced hiring freeze, but I think their hiring freeze was just temporary. They told some 6 months of hiring freeze. Right? It is almost impossible to predict on what the stock will do after earnings. We've been watching this for years now. If the the quarter results are great, the stock could go down because the guidance is poor. If the guidance is good, stock could go down because, hey, we had priced in better than what you guided already. So it's impossible. All I think is it's gonna be little volatile. Facebook, Alphabet, they already took a beating this week, right? So some sort of a negativity is already priced into it, because I think Facebook was down more than 5%. I don't know about Alphabet. Maybe I think it was also down around 3%, 4% maybe. So some of them was already got priced in, but it's impossible to know what market's gonna do after earnings. All I know is, hey, earnings season is there. These biggies of the market gonna report the results. So it's gonna be a little volatile, and which also shows up right where the VIX is. So market is closer to 400, but if you look at a VIX, that hasn't gone down. I mean, it's still hovering at around 23, 24, which is pretty surprising. If the participants are becoming more optimistic and S&P is raised down, so raised up almost to 400, why the VIX hasn't gone down? To look at, VIX is still pretty high from from their average value. So I think there's still soft underbelly around. People are still, even though the S&P is at 400.
I think they have, right? They were at 40, right? They're now coming down to close to 20 right here, right?
It's almost 24, right? 23, 24. I think I was listening to some podcast wherein they're talking about when was the last time when S&P was around 400 and the VIX is around closer to 24. It's been years.
But look at those spikes, right? Yes.
Oh,
How
those,
many times,
I mean,
right?
those, but the S&P is down during those spikes, which is okay. I mean, that's what we expect. If the market VIX spikes because the market goes down. What is little baffling this time is market is closer to 400 and the VIX hasn't come down.
I don't know. I've been buying VIX. So.
So it has, I mean, that's why some of these options premium are juicy, works out well for premium sellers because the VIX continues to stay high. So it means at least for the market is anticipating volatility, whether it will materialize or not, that no one knows, but volatility is priced into the market for now, with VIX staying closer to 25. That's strange. So the little soft underbelly. Jay says, I don't want VIX back at 13. Those were the days. I don't know if you remember 2017, VIX at single digit and still sold premium during that. So once VIX went up to 15, 16, I was like, wow, it's great. and now VIX is like 20 plus. This week, those are not this year has been great because VIX has been almost above 20 plus, which is a great from option selling perspective. Yeah, I don't want it to go back to single digits. Those were difficult days. Looking at fear indicator, still in a fear zone, little better than a previous week. And this is how the greed and fear indicator has been trending. Of course, those November 2021 extreme greed and during earlier year, but yeah, but I love this chart, right? Let me make sure I can expand this a bit more, right? This talks about Dow Jones Index from 1916 to 2022. Obviously, I think I don't want us to read everything, but it basically lists down all the big world-changing events. Many times when we think that, oh, it's all bad, it's gonna crash, never gonna recover, but sometimes, I mean, today we are in a similar situation, right? Inflation high, Russia-Ukraine conflict, the banking crisis in China, but yeah, things, market is resilient when it comes to long term. So I love this chart. Whenever you feel little depressed on what's happening in the market, expand your time horizon and look at how the markets have behaved over a long period of time. From that perspective, this chart is really good reminder of why I should continue to stay invested and not get scared out of the market. The chart which does scare me is this. I know in US the inflation is 9.1%, but look at some of the other countries. Right? Zimbabwe, Turkey, it's 100%. Sri Lanka, 116%. That country is now gone to talks. Pretty bad stuff over there. But yeah, that's pretty bad for these countries. We are feeling the heat at 9%. So should see a lot more turmoil in, developing countries. We're already seeing it, right? With the strength in the dollar. So look at dollar index is just gone crazy.
Vivek, this is Sam. Sorry it took me a while, but how do we differentiate inflation that we're experiencing and what the nation is experiencing? Because according to some articles that because people are moving out of Northern California, we are experiencing less inflation than, say, Austin. How can we differentiate this?
So there is, I think, something called a Chapman inflation index, where you can go and find out what the real inflation at a particular area. Obviously, 9.1% itself is, the official number itself is, I would say, is manipulated, because that's not the inflation that a common people face. I mean, the food prices are up more than 25%. Housing prices were up. Now the housing has a little cooled down, but they were still up. Like last year, those were up like 19% and all that stuff. So the real inflation, all on average, is around 16% against the reported number of 9.1%. But even from looking at area specific inflation, I think that's called Chapman or Chapwood index. Just search for it. That also tells you what's inflation in, let's say, Bay Area. Morris says, where did you find the chart? I guess, Morris, you are referring to inflation, or this one. I think somewhere on Twitter.
Yeah, I saw on Twitter. It's on Twitter somewhere.
It was somewhere on Twitter. Yeah.
Just Google it, man.
Yeah. So real estate. The demand for the mortgage has hit 22-year low last week. But again, it's and the home sales have fallen for 5 months straight. Because, and this is what continues to baffle me, is the reason the home sales have fallen is because the median price has hit a new record of 416K in June, right? The inventory is low and the prices are going high, and the first-time home buyers are getting priced out and they are not buying, and then the home sales are falling, and now people are reducing the cost. And then the roof rates, which is the cost of borrowing, obviously no surprises here. Those have gone through the roof from 3% earlier this year to almost 5 point something. And then now this is a little difficult to disconnect, to connect both the things. Saying the average housing market is only for 14 days before it's sold. But so it means there is a demand, but we are seeing home sales have been falling for first 5 months. So it looks like whichever houses are in affordable range are getting lapped up quickly, but most of the houses are either the houses or the cost of mortgage to finance that house is out of a reach for most people. So yeah, the average US worker need to pay about 1/3 of their income to afford a median price home. This is the highest level since the housing bubble. So, and some of the hottest areas of 2020 and 2021, now we are seeing the inventory of available houses just shooting, are increasing. And this is from St. Louis Fed data. Boise and Phoenix were two such areas which had seen tremendous, mostly I think it's a tremendous investor interest of buying properties in these areas. But starting from this year, the available inventory, like from 1,000 houses, Now it is more than doubled, 2,200. Same case in Phoenix, is from close to 4,000 houses. Now it is up to almost 10,000. So I guess those who had bought in 2020, 2021 at the high prices may have to bring their prices down. But we'll see. I think this is one area where we haven't yet seen, at least on the US, the impact on the houses just yet. We'll see. Other one which caught my eye was a report from Wall Street Journal in which Berkshire A shares trading volume saw a huge jump from the normal volume that is there, right? So when I'm talking Berkshire shares, so Berkshire has got two classes of shares, Berkshire A and Berkshire B. Obviously, I don't, I hold just Berkshire B in my portfolio because that is affordable from a single unit perspective. It's $285, $300 stock. But the Berkshire A class shares, which are held by the people for decades, is almost $500,000 of 430K. So generally, the trading volume on Berkshire A will be de minimis, right? 300 shares will get traded on any particular day. 400 shares will get traded. There are no options on this one, and the bid-ask spread is so wide. But what we've been seeing over the past few months was sudden surge in trading, right? 2021, and now we started seeing that from March of 2021, the total volume or the number of shares on Berkshire Class A suddenly start to increase. It jumped from close to 300 shares per day to close to 2,000 shares, which was baffling because most of the holders of Berkshire A shares are either the big institutional holders like Fidelities and the Vanguards of the world, or those are the holders that haven't sold any shares for decades. People who bought the Berkshire A shares when those were the only shares available and held it for 40 years, 50 years. These shares have been passed over from generation. So it was really surprising and puzzling to see why the sudden volume has increased. And when I read through the report, I'm like, what? So strange, right? And this is where some of these regulations muddy the whole real picture. So even Mr. Buffett was puzzled by the reported volume, and he believed that they were wrong because he did not know of, there are few thousand holders of Berkshire A, and Buffett did not know anyone who's been, selling their shares or who've been actively trading their shares. So they were like, what the heck is happening? So there was a study done by, I think, 3 professors. It was including University of California, Berkeley. There were 3 universities wherein the professors, they went on a mission to find out why this happened. Now, the reason, and it is so funny when it came to no reason, it's called a rounding up error. So whenever we do any trade, the brokerage firms will report those trades to the trading reporting facilities. So that's where then we figured out, okay, what's the overall volume of those shares, because they all report to a centralized trading reporting facilities. Now, when such of the trade involve the fractional amounts, FINRA requires the firms to report the trades as though if those were one whole shares, which is crazy. And in in 2021, Robinhood started to report those fractional shares to these trading facilities. And obviously, the common investors, they don't have accounts big enough to buy one full share of Berkshire Hathaway A-class shares. So all they ended up was buying, some fractional share. But because of this FINRA rule, which I think is pretty old, they may have to refine it now. They had to report it as if they were buying one whole share. So even the small investor purchase of 1/100th of a share would count as one whole share. That's called like a rounding up error. And this is why we saw such distortion in the reporting of Berkshire A shares. So now no one knows what's the real volume. It's also interesting to figure out, how some of our regulations have yet to catch up with the realities of investing. So that's an interesting article in Wall Street. What also found interesting was we talked about programmatic advertising in our previous session, went through the whole 9 yard of how the programmatic advertising really work. We talked about demand side platforms, sell side platforms. And this week, the last week, Netflix announced that they're tying up with Microsoft for Microsoft to become their, kind of a demand side, to provide them a demand side platform capabilities. Now, obviously, and they'll also help Netflix for their ad-supported subscription plan. Obviously, they could have found any other tech partner, but Google is a competitor to Microsoft through YouTube. Amazon is competitor to not Microsoft, but to Netflix. Amazon is competing with Netflix through their Prime. So they really, I think what worked out in Microsoft favor was, hey guys, we don't have any streaming service, so we are neutral, right? But good to see these two giants coming together. But looks like Microsoft was already, they didn't realize that they'll probably end up in time with Netflix, but they started working towards building an advertising service by acquiring a company called Xandr Advertising Platform from AT&T in 2021. At that point of a time, Microsoft thought was to monetize their gaming platform, and they wanted to build up an advertising infrastructure to show ads in the games. Right. But as luck would have it, in 2022, Netflix pivoted towards showing ads and creating an ad-supported subscription plan. So that really came out at the right time for Microsoft. And now Netflix and Microsoft had tied together. It is the most independent, but it is untested player. Right. On the other hand, Disney also want to move towards the ad-supported, little cheaper version of their streaming. And Disney has tied up with the Trade Desk. So we did a deep dive into Trade Desk previous week when we looked at the overall programmatic advertising. So this still, reconfirm our thesis around the growth in digital advertising, right? It's here to stay. So I think investing for a long term into any one of these platforms which provide tools for digital advertising could be a good from a long-term perspective. So Disney tied up with the Trade Desk, and Trade Desk will basically be their DSP and excuse me, will help Disney's ad on their linear platform like ESPN, plus also the streaming platform. Right now, Disney has both. right? So overall, the growth of the programmatic ad is still healthy, and digital ad spend is likely to increase 14% on an annual rate. So I guess our deeper dive into the programmatic advertising was really timely. We're seeing companies, especially like Netflix and Disney, moving towards more ad-supported plans, which is good for the players in programmatic advertising. So I do hold Trade Desk share. I hold Disney shares. I do not hold Netflix shares. Yeah, let me know if you have any questions. Otherwise, I'll continue to move ahead. What else? What else in the market? Amazon third try in the healthcare segment. Ramesh says, I had to roll covered Netflix calls after the Microsoft tie-up. Isn't that a good problem to have when your covered call are getting challenged? That's a good problem to have. So this week we heard from Amazon, they spent $3.9 billion. Big amount, not a petty change, to acquire a company called One Medical, which provides primary care service and also has a virtual care. This company operates in almost a dozen US markets, and it works with almost 8,000 companies to offer this to their employees. Now, we talked about Amazon. Every time they try to enter into this healthcare space, this is their, I would say not third, but third from a public perspective. So Amazon had acquired PillPack, an online pharmacy, in 2018, and using PillPack as their the platform, they launched their own digital pharmacy. Then Amazon also basically set up their for its own employees. It set up a plans and managed to manage their health plans. Right? Third one, Project Haven, in which it partnered with JP Morgan Chase and Berkshire, and this was like big in news, saying the leaders of US I would say the US companies, the big leaders, the most respected leaders in the US businesses have come together to solve the biggest problem in US, which is the huge cost of healthcare services. So Amazon, Jeff Bezos, tied up with JP Morgan Chase, Jamie Dimon, and Berkshire Hathaway, Warren Buffett. But this project didn't go anywhere, and I think they shut it down last year, or maybe in I think last year they just shut this down. It's not an easy problem to solve. So now Amazon is going on its own by acquiring this One Medical. And what I heard about One Medical is like they got very cool facilities, right? I mean, it looks like you are in a hotel if you move into One Medical centers. Anyway, so there is not so first it was little baffling to see Amazon into this, because this is not a big, the margins in these businesses, right? The direct care business is not that huge, but knowing what Amazon can do, I mean, they are famous for operating businesses with the smaller margins, but they know how to scale those businesses. So let's see if Amazon can actually make some, make some money out of this business. But what also scares us is the way in which Amazon had been expanding its wings or claws, what you may want to call, across different companies and different segments, which as a consumer or as a human being, I need to do it. I need to survive. So there has been a lot of talks around how much Facebook know about us, the amount of data that Facebook has collected, amount of data that Google has about us. And, by offering us what free services and collecting data from us when we visit Facebook or Google, right? But here comes Amazon. Amazon is collecting a lot of data about us, and it's not even free. I mean, we are paying Amazon to, and also giving our data to us. So Amazon knows how we shop, obviously, because of their retailing website. They know what we watch. So they got a Prime Video. And now, obviously, they also want to generate a lot of in-house content. So they bought MGM Studio, catching up with Netflix. Amazon knows what we eat through their ownership of Whole Foods. Amazon knows how major companies run their businesses on cloud through their AWS. Amazon knows what we discuss at home, Alexa, and now, they'll also have a lot more information on how we are managing or mismanaging our health, because now they get access to the health record. So,
Vivek,
yeah.
Can I interject about one thing?
Sure.
On medical? The thing is, it has to be affordable. We don't care if it's luxury. In China, I was not a citizen, so I have to pay the regular rate. But compared to the U.S., I paid very little. I mean, of course, I was more privileged, but I mean, it's ridiculous how the system is run here. I mean, okay, sorry.
No, you're right. Absolutely right. It is crazy.
Another thing. When you were in India, did you think that America was like, all these smarter people, and it's a better place? And what do you think now? Like in high school, I had a friend from Taiwan. He said, before you get in, you see the high walls, but once you're in, you realize it's just kind of, stupid.
No, so again, I'll limit it to discussions or investing. But quick answer is, I still think that US is still a better place to live in. But yeah, we have in the US, we have our own problems, like this whole expensive healthcare. In India, it's way, way cheaper. I mean, even if you don't have, most of us, we don't have medical insurance in India, right? I just went there. I went to India. I had to take my niece for some dental work. I mean, we don't have insurance there, and it's so easy and so cheap to get any of those things done. But yeah, that's a problem here from a healthcare perspective. It surprises me ever since I moved to US. I'm like, why the heck it's so expensive? I just couldn't wrap my head around it, because it's way cheaper in some other countries. But overall, I still feel the quality of life is way better in here. So, and the reason could be different, right? Dollar hegemony or whatever you may want to call it, but from overall quality of life, it's still way better here. That's why I'm still here.
If you don't mind.
Sorry,
go ahead.
Oh, no, I was just about to move forward. If you have any
questions. Just one quick comment or question, whatever, you can take it the way you like. How is tourism for medical? Like you mentioned about India and dental, and I'm in the dental field, and I just wanted to, I've been thinking about, here people come for, like when they lose all the teeth, we try to do all-on-4 or some kind of implants and denture on that, and it can cost anywhere from 50 to 100,000 sometimes. And if you go to India, you can get it for a small fraction and have tourism as well.
Oh yeah, so medical tourism is nothing new. I mean, what I read, and not recently, I mean, there are agencies who actually there are businesses who help patients do this, and not just India, but even on, why go all the way to India? I mean, even in South America, people go and get their procedures done in let's say the best of the hospitals, and getting taken care by the best of the doctors, but way cheaper than what they can get it done in US. So it's real, and it is already there. And if I were to, just because I have family in India, if I do do it, I won't hesitate to do that as well. I mean, it's super expensive out here, but fact that most of it's covered by insurance, so people like us, they are still okay. But it's the cost is ridiculous. One thing I did get done while I was in India is to get my dental guard, doctor. So I got one done here. It cost me $500, right? While I was in India, I thought I need to have one extra dental guard. It cost me 2,500 rupees, which means $30. $30. So that's, this time when I went, I'm like, I want to have an extra one, and I got one at $30. So huge difference. But I think it is reality.
Thank you. I agree with you.
No, I mean, it's some of these things are yeah.
Hey, Vivek, have you talked about Tesla, or that's to come?
Yeah, we'll go to Tesla when we'll get to the earnings. So continuing on Amazon, and I think Amazon is also not just Amazon, but we are seeing much bigger companies are now getting little worry about the whole antitrust. And two reports that I saw, one is Amazon will be slashing their private label selection. Obviously, the sales are not as great as what they were expecting, but also if they remove the private labels, they'll bring down the regulatory pressures on them. So, right, the biggest antitrust concern that the regulators have with Amazon is that because they have data of all the merchants, they can use that data and improve their own branded sales. Now, if they won't even have a branded product like Amazon Basics, then that's no longer a concern. So we saw Amazon doing it. We also saw news that Google may spin off, their ad business into a new unit. So as a shareholder of Google, this is really be great for us, but we'll see. I think looking at what we saw in EU, wherein these big tech companies were also fined by the regulators in EU for the for their monopolistic behavior. We are seeing these companies trying to change. Even in some cases, it might just be window dressing, right? This Amazon Basics is anyway not selling it. Why not shut it down and look good in eyes of regulators and get some of that pressure off. Other big news is around what happened between Oracle and Microsoft. That is interesting from the perspective of we are seeing these companies moving to cloud. Then we realize companies don't want to get tied into one service provider, so companies would do a multi-cloud or hybrid cloud. But this week's announcement from Oracle and Microsoft gave me a new thought. Is what we may see is also collaborative cloud. And this is a little technical. What Oracle and Microsoft have done is they announce the availability of Oracle database service within Microsoft Azure. So if Oracle has got their own cloud service, though no one talks about it, but those are Oracle is the underdog behind AWS, Azure. Third is Google Cloud. Fourth is Oracle. I think then the fifth is IBM. But they've been starting to build their cloud services over past few years, got some good names, some success, some marquee names like Zoom, which is hosted on Oracle Cloud, TikTok, 8x8 Communication Services, and recently they also bought what's Cerner, that healthcare company. They're going to move them to Oracle Cloud. So they have had some good wins on the cloud perspective, trying to catch up with these three big players.
Oracle and IBM were in the cloud business in the 90s.
No,
Before Amazon. So they just kind of did nothing.
yeah, I mean, I must have been like a Dr. Watson project that, hey, we are a pioneer, but never encashed on it. So they also were a pioneer in data analysis when they actually had their Watson service available. But now we are seeing more companies like Snowflakes and the Datadogs. And I mean, that was more on the AI side. But again, that service didn't go well. But now I am hopeful that with the focus on cloud, especially elevating Arvind Krishna, who was managing their cloud business, he was elevated to CEO. IBM might catch up. So, but I think they are like fifth in the race. So we saw a tie-up between number 4 and number 2 is if you go to Microsoft Azure, you could still get Oracle Cloud database, which is hosted on Oracle Cloud without tying up with Oracle Cloud. It's like two cloud companies are coming together to offer a service. And both of them have their own reasons, because Azure doesn't want those customers to go to Amazon AWS. And if they have their needs of a faster database, I guess Microsoft will now rely on Oracle to provide those services than their own SQL server. But the net of this is that even if you are a Microsoft customer, you can still run your mission critical workloads across Microsoft and Oracle Cloud. You don't have to buy a big on-prem Oracle Cloud license and all that stuff. You can build with Oracle on Azure. So this is how it looks like from a diagrammatic perspective. This is your Azure. User come in, they work everything on Azure, but the data is not hosted on their data center on Oracle database. The data is all in the Oracle Cloud. So basically merging of these two clouds and providing a single solution for the end customers. So which is great. I don't think I have seen similar announcements earlier. Like Microsoft, if you're on an AWS, you're on AWS. Everything will be hosted on AWS. Even the SQL Server from Microsoft will be hosted on AWS. But here we are seeing these two coming together and collaborating, so that Oracle does best on the database side. All right, you guys host the database. Microsoft does the best on the application side, so they'll run the applications. We'll have to see how the uptick would be, but this was something which caught my eye. I'm like, okay, this is different than what I've seen so far on the cloud business. Still makes me, I'll continue to have my bullish thesis on Oracle with this, just from the growth that they have seen on their cloud business. So watch out for Oracle. They are underdogs on the cloud business. And all the growth that we are seeing in Oracle, not now. Let's go back to this one. All this, what we saw was because of their growth on the cloud business. So keep an eye on that. This is an exciting announcement. Now coming to earnings side. So Tesla reported earnings. Right. Overall revenue grew. If you look at the total revenue, overall the revenue grew 42%, which is great, year over year. Automotive revenue grew 43%. So in line with, now the most of the revenue is coming from their automotive, which is great. What we also saw that there was a growth in the vehicle delivery, increase in the average selling price, and the growth in other part of business. But from a profitability perspective, the operating margin was only 14.6%, which from an automotive company is good, but we consider Tesla as a technology company, or from a valuation perspective, Tesla is considered as tech company. From that perspective, this margin is not good. Right? And of course, these were impacted by the higher raw material cost. They had new factories that had started. So the expenses on those factories impacted their operating margin. We also had seen shutdowns in Shanghai, which impacted the overall, revenue of their company and also impacted the operating margin. Plus, they also negative foreign exchange impact. We are seeing more and more companies starting to talk about that FX impact, right? Going back to the chart that I was trying to show earlier is our dollar chart. This is where the impact is seen. Now, if you look at it from the dollar, it's just going up north. Right? From 96, this dollar index is now up to 106, which means close to, it's more like almost 15%. Dollar has become stronger, right? 15%. So when the dollar becomes stronger, the companies that derive a lot of revenue from outside of US, they get negatively impacted, because if dollar has become stronger against the currency where they are having more sales, when they have to come back and report the results in dollars, those numbers will go down, right? So that's why we are seeing negative foreign exchange impact. So base example is, say if and this got impacted because dollar became strong against Chinese yuan, right? So other businesses, if you own shares, let's say in Nike, in Starbucks, in Apple, those are all subject to foreign exchange impact, right? So be careful of, even though their units sales might have increased, their local currency results would have been better. But when you report those results in dollar, you might see, some of these gotchas. These are the stuff which is not in their control. Right? So anything that derive their revenue from currency, majority of revenue from currencies outside of dollar will face the heat because of a stronger dollar. And that means we should also see more companies talking about the results in the local currency, right? Because when you talk about that, you will be able to show the growth or talk about the growth, saying in the local currency we grew 26%, but our dollar, that's called that FX neutral. So they'll start reporting saying FX neutral results up 25%, but from a GAAP perspective, they are up only 20% because 5% is foreign exchange impact. So we should see that. So Tesla started to talk about it. I guess many more companies will start to talk about it. Also, Tesla had to take impairment charge for Bitcoin because they sold off 75% of the Bitcoins that Tesla held on its balance sheet. Right? Why did they do it? I don't know. Maybe they want to generate more cash. They want to hold more cash, given the fact that the lockdowns in China, they didn't have as great a sale as what they would have been expecting. The operating margin is, or also there was a pressure on the operating margin side also. So they want to increase their cash. So sold Bitcoin. So from a cash perspective, it increased sequentially by 902 million to now 18.9 billion. Also mostly the sale of a Bitcoin added $936 million of cash to Tesla's balance sheet. What else? Some of the concerns is quarter-on-quarter gross margin decrease. So Nirmal, you're right. The margin, so gross margin had decreased 40% from quarter-on-quarter. Let's look at the numbers. Right, to their operating margin was 358 basis points. Sorry, quarter to quarter, we look at operating margin is 14.6%, right? So if we look at from a previous quarter, it was 19.2%. And I think this is the first time that their operating margin actually have decreased in a quarter, right? Which is never a good sign. Even looking at the gross margin, same case. So this quarter, they really had a cost pressure, right? Cost pressures combined with the shutdowns, which mean lower sales. So what else? China lockdown impacted their business. And finally, be careful. No one talked about the Twitter stuff. Analysts didn't ask the questions on Twitter during a Tesla earnings call, but this is one area which could, which could surprise on if Elon is forced to honor the commitment to buy Twitter. He'll have to dump some of the Tesla shares, and that, even if nothing to do with the Tesla as a business, won't be good for the share price of Tesla. Something to be aware of. I don't think that Elon could just get away with paying $1 billion of a breakup fee. I guess either he has to pay higher fee, or maybe he has to buy it at whatever, $44 billion, right? He has the best lawyers that anyone can afford in this world to basically present its case to the Chancery Court in Delaware. And but let's see. I think in the history of Delaware court, we haven't seen wherein the court has actually favored a company, walking back on their commitment to honor the contract. We'll see.
Vivek,
Yeah.
why would the Twitter management want to force Elon to buy it if he doesn't want to do it? I mean, it's not beneficial to the shareholders.
Shareholders gonna get $54
Okay.
if they have to buy it, because that was a share price, right? $54.20, right? No, where is Twitter? I know
32.
long term doesn't make sense, because if you really look at it, now they are fighting with someone to whom they want, they're fighting with someone to ask them to come and run their business, right? Long term, probably not the best strategy, but $54 is what, 40% from here? No, whatever, 40%? It's like $40, 54 become another $14. Yeah, whatever percent. My math is not that great. So yeah. So I think that's where both the companies are in pickle. I think initially they didn't want it to buy it, but then they forced it. So then they agreed to buy it now. Elon developed cold feet because of how he's going to come up with all that money, and his excuse saying around the bots just doesn't make any sense. It's not that he was not aware of the bots. It was the main reason why he wanted to buy Twitter, because he told this bots is a problem and I want to buy Twitter and fix it. So anyway, and he waived off all the due diligence. It's like, if I'm gonna buy the house and I put zero those conditions, and then I suddenly, after housing prices cool down, I'm like, okay, I'm not gonna buy it. It doesn't work that way. So, but we'll see. He's got the best battery of lawyers that money can buy. And so let's see how this drama plays out in the Chancery Court. Whether it's a billionaire wins, or whether the contract law wins. So we'll see. But if he is able to get out by just paying $1 billion a breakup fee, then Elon still wins, because he already sold a lot more Tesla stock under the pretext of raising money for Twitter at much higher price than where Tesla stock is right now. And then, given that he can also take this $1 billion as an expense and save on taxes, there are some calculations that were overall, even after paying $1 billion, Elon Musk will be in green by $300 to $400 million. So if we pay $1 billion and get out of a deal, that's even that's good for Elon. But let's see how this drama plays out. Yeah, Twitter investors will be upset. Yep. Yeah, and I pity the Parag Agarwal's position right now. He's just like a puppet. I mean, he doesn't know what he will face. When he gets up in the morning, what is Elon gonna do to his company? Has no idea, and this poor fellow is being just tossed around. Next earning was around Snap. By the way, I mean, last thought on Tesla is we should see more competition coming in for Tesla. So far, Tesla is still the highest selling car, EV car in US, but the world over, it started to lose its position. Right? In China, it is BYD, which sells the most EV cars. In Europe, it's a Volkswagen that had dethroned Tesla from being the most EV car seller. US, we still have to see it, but yeah, competition's coming in. There's competition coming in. We'll see.
GM is claiming by 2050, I believe, that they will be able to overtake Tesla. 2050?
GM investors won't have that patience, but very possible. I mean, I am bullish on GM and Ford both, just only because of their EV plans. But we'll see how. I mean, at least in last 1 year, they have shown that their EV is not just a strategy on books, but they also can produce EV cars. But we'll have to see how long can they sustain. I mean, they'll have to go through the same problems of recalls and all that, which Tesla had gone through. But we'll see.
But like Alan Mulally said, when he was called for the interview, he told Ford, look, you're telling me your cars are so complicated that there are millions of parts. Where I'm coming from, I was at Boeing and we had much more parts. So I can do this. Same thing with electric. It's not rocket science. If they can do IC, internal combustion engine, with all the complication, electric is much more simpler, less parts. Yeah, there is technology, but there is also, R&D that they have been doing. In fact, GM was the first to get a hybrid, like some EV1 or something.
Yeah, I mean, I don't know about the hybrid, but GM is the first one to get the license for driverless cars in
Yes.
in San Francisco, right? Their cruise automation. So
Yeah.
their autonomous driving is, I mean, Tesla couldn't get it, but GM has got it. So I'm bullish on that, both on the GM and Ford, just because from
Tesla is behind on that also in China because Baidu has taken the lead. They're already launched and it is working.
yes, by those much
Taxi.
I agree. I mean, Tesla's was the only player and it had first mover advantage to which it had played for years, but you just can't rely and, you know, rest in the laurels of the first mover advantage that you have had. From making of the cars and the safety of the cars, Tesla cars are not that safe. From safety rating perspective, look at a JD Power rating, Tesla ranks way below from a safety perspective. But there was no other option. So what else people will do? I mean, if they want to show that they are pro-green, just buy Tesla EV. So, but if there are other options, why people won't go for other options? So yeah, so my EV plays, and want to be transparent, I who have GM, Ford, NIO, and Xpeng or Zhang, whatever, however way you pronounce it. Those are the 4 EV stocks that I own in my portfolio. I don't have.
To add to what you said, just like Steve Jobs was flamboyant and everybody wants an iPhone and all of that, he developed a brand, a cult. That's what Elon Musk is trying to do. He is the product, kind of, right? Whatever he says, people are.
And he has succeeded.
Yeah,
I'll give to that. I mean, Tesla's the buyers are ardent fans of Tesla as a brand, even though they'll have a problem in the car. And I have 2 friends who have those sort of a problems, which my ICR never have had. Right? I'm like, you can, but they still talk very highly of Tesla. I'm like, even after those problems, because they're good fans. I mean, it's a people talk about Tesla with passion, right? That doesn't.
What about Apple? Are they going to come up with an EV?
Apple car has been on and off. Again, we don't know, because unless Apple come and talk about it, but they have had the ambitions of working in a car space, right? Whether they gonna come up with their own car, or they're gonna just focus on the design, and obviously they'll have to tie up with someone to make a car.
They usually outsource. They had Foxconn do their phones, so they will find somebody to do their car.
The key, was it Kia? Or there was one South Korean, was it
Korean?
Yeah, South Korean, which one? But they actually came and talked about it. And then if you're working with Apple, you never talk about what you're working on. And then Apple snubbed them. But there are rumors, because there's nothing confirmed from Apple. There are rumors that Apple will work with some of these, OEMs. It could be even, at some point of time, there was rumor that it could be even Magna, that they make cars for Apple. But I think Apple definitely have ambitions to get into the car infotainment center. I think they already revealed what Apple is doing to make to be a player on the infotainment center in your car, right? You're seeing, or basically playing using Apple operating system. So we'll see.
Apple?
Yeah, Apple revealed in the recent, whatever the worldwide conference they had, they showed how the speedometer could look like, how you could play. You're in an entertainment center within the car. So they do have ambitions on that. Again, most of the people think, or analysts think, that Apple probably will end up in designing the car, and of course will rely on some other manufacturer to manufacture it. Sam says BYD sells junky cars. Tesla is luxury. I don't own BYD because they don't have options, but I know Warren Buffett is big on BYD. He's been holding those shares for long, and I haven't followed BYD as a company, but they are the biggest EV car seller in China. Ramesh says, yeah, Apple can't handle manufacturing. Yes. I don't think they probably will tie with someone to manufacture the car. Next, Snap. So not surprised, Snap already kind of hinted earlier that they won't be able to meet their forecast. So their results, they also plan to slow their hiring. Same stuff, challenging economy. When economy is challenged, the first thing that corporates will cut down is their advertising platform, where they cannot have one-to-one ROI. So they see the slowing demand for their ad platform. Of course, blame everything on Apple for their iOS update, wherein do not track. They empowered users to come and say they don't track me for showing any ads. And lastly, competition from TikTok. Given all these things, Snap also told that they don't want to issue any guidance for the third quarter. But over a long trajectory, we are observing a fairly steady deceleration in demand over the last year. So when you see these words coming out of the mouth of a CFO, it's never good for the stock. So we did see snapped by what, 30% after reporting the results. It was almost like
40.
Yeah, or maybe 40%. Yeah, it was 39.08, almost 40%. So this same stock was close to $90, $85 a year ago. From $85 to now close to $9, lost almost 80% of its market value. And Snap has always been very volatile during earnings. And surprisingly, on the same day, I think it was AT&T, those who have also reported, AT&T had an 8% drop in their share price after they reported the results. Again, not the results were bad, but I think we'll come to AT&T later. But the reason I want to bring that reference was AT&T shares dropped 8%, and that was the biggest drop in AT&T share in a day in 20 years. In 20 years. And like companies like Snap, etc., they go 8% like twice in a week, But it was down 40% on the fact that they are seeing a deceleration in the demand, right? So again, challenging macro. Every company that's now being challenged, because it's dependent on ad business, and are being challenged because their customers are reducing the spend on ad, will have a similar story of macro environment, right? But the CFO also said, saying just as businesses can quickly ramp down ad spending, they can quickly and easily ramp it back up, right? So trying to give a spin, saying, hey, if as and when business will come in, we will be ready to meet businesses when they want to increase the spend. So they want to focus on 3 areas, pretty generic: invest in product and platform, invest in direct response advertising business, and something new, which we saw, was a monthly subscription service. So we saw Disney coming up with ads supported service, Netflix. Each of these companies are now trying to diversify and find additional sources of revenue. We saw Snap coming up and saying they want to have a subscription service in which I think it's $4 per month. But if you are a part of that subscription service, you get access to some of those new filters, much sooner than before it is released to general public. for free. So on an average, their active users continue to increase, though the growth has slowed down. But they've been innovating. I mean, they've been adding more and more functionality on their platform. And with the 5 core platform, right? Snap Map, communication, camera, stories, and now the Spotlight. So I hold Snap in my portfolio. I will continue to hold it. I have gone through these 30% drops, 40% drops, 20% high over the years with Snap. So that doesn't scare me. Again, the focus is continuously trying to reduce the cost basis and let the story play out. My main story is their focus, and I think they are right now of all the other streaming platform, not streaming, social media platform, Snap is the most advanced when it comes to helping businesses generate revenue using AR. So that's why I'm still bullish on Snap from that perspective. Of course, these macro challenges will come and go, but as long as they continue to innovate and add more and more features for businesses to benefit from it, I think I'll still continue to hold Snap in my portfolio. Lastly, from news perspective, we saw YouTube joining hands with Shopify. I hold both on my portfolio, so good to see both of them coming together. Again, YouTube want to give more and more tools to the creators to be able to sell their content, and who better to tie up with than with Shopify to provide a seamless checkout experience to the content creators and to the viewers without leaving YouTube. So it's gonna be in a context experience of buying the content from YouTube creators. So you're seeing an ad on YouTube, you want to purchase it, whatever is being shown to you, you don't have to go to another browser. Everything you can buy within the YouTube context, and Shopify will be able to manage the inventory and everything else, which is good. We'll see. So that's all around on the US side and some of the things that caught my eye. Other thing is around what's happening on the China banking crisis. We don't see these things often because obviously a lot of these news get censored. We don't see it on traditional media, but in I think it's a Henan province of China, banks froze the deposits, right? And Chinese depositors, they were not able to withdraw the money that they had deposited in the banks. So those mostly these banks are what you call as a regional rural banks in China. There are almost close to 4,000 of such banks that exist in China. It's similar to like credit unions, right? They serve a particular area and they are not allowed to expand beyond that, their catchment area, beyond the designated area. So, but what we saw in many of these banks who are serving, mostly around the rural communities, people started to migrate from rural community to urban. So we saw these banks started to get challenged in terms of the amount of deposits that are available to them. So they started to look for newer ways to increase their user base, right? They can't physically, they can't expand beyond their designated area. So they started tying up with fintech platforms to offer, online banking so that people, even though it is kind of illegal, but it's become difficult to catch by regulators, and allow people to sign up for just online banks but to attract them, they had to offer, higher interest rates, flexible terms, higher interest rates. And for that, they tied up with all these fintech platforms in China. So people started signing up with some of these banks, right? And now they suddenly realized that they were not able to withdraw money from their banks. Why? Again, we've seen this in the crypto world also. Now, if you are paying, so the interest rate set up by PBOC, People Bank of China, and the regulators, the big banks, is around 2%, which is way, way higher, way better than what we get in US. But these rural banks tying up with fintech platforms were offering like 4% to attract more depositors. The reason why they were able to get 4% is they had to lend that money out to other companies and charge more than 4%. Right? So if you for that, they had to reduce their credit. They had to loosen their credit policies on who to give credit to, and then they offered these loans to a lot of property developer firms like Evergrande and some of the other firms. Given the route that's happening on China's property market right now, we saw earlier this year Evergrande defaulted. Now these banks are in trouble because many of these firms are not paying back their loans. So now they don't have the cash available to make whole all the depositors if they want to deposit, if they want to withdraw all their deposits. So what they did, they actually put a freeze on online and mobile cash withdrawal services, right? So people started to protest in front of banks because, hey, if my savings, and people put money in the banks because the banks are supposed to be trustworthy. I'm not putting money in, let's say, a crypto lending firm. I'm not putting money in, say, a new tech IPO, a fintech company. I'm putting money in a bank that's supposed to be a safe bank, protected by the government. But they were not able to withdraw, so they started protests. Multiple protests, but China being China, some of these protesters also found out that when they are coming to the city to protest, their COVID passport turned red. So it means if your COVID passport turns red in China, you are sent to government quarantine facility, or you're not allowed to enter the city, right? And you are turned away. So many of them were turned away. I mean, these things do happen in China, right? And those were turned away when they went back to their own place of residence, COVID passport turned green, right? So this is what, when government controls everything and wait until the CBDC become the reality for in China, the amount of a control that the government can exercise on residents is going to be mind-boggling.
So the military really protected very well these banks, and the government is protecting the banks.
Yeah.
So the military is out in the front of the banks.
Yeah, yeah. So
Thanks.
I do have a picture for that. Yeah. So there's a distress happening in China, over leveraged property developers. Evergrande, we talked about it earlier. They defaulted on their dollar bonds earlier this year, but they are not the only one. So with the latest delinquencies, offshore bond delinquencies having exceeded $26 billion so far. So their bonds, the China's bonds, so there is a developer called Country Garden, long for Wanke. All their bonds are now selling at deep discount, right? If you look at this Country Garden, which is one of a big property developer, it's bigger than Evergrande. their bonds are selling at 50 cents of the dollar, because the investors who bought these bonds are not sure that they'll be able to, that the developer will be able to pay the interest on the bonds. So all these bonds price, the bonds offered by these developers are now selling discount at way higher discounts, right? 50% off. This is almost 30% off. So when these developers go under, it's not obviously developers will get screwed, but imagine the banks that have loaned to them will be under pressure. And many of these banks are, so, these rural banks, plus the top 4 big commercial banks of China, right? Property, it's a safe instrument, it always go up. We have seen this story earlier, right? Property prices always go up, even if, and many of home buyers had invested in apartments that were not even built. Some of them are not even started. The whole idea was, fine, if it's okay to delay it, it'll go up, I'll be able to flip it. Banks also thought the same stuff, will be able to sell these property at a higher prices. So they lent to these Chinese developers, hand over fist. So now many of these banks are holding a commercial paper from these developers. But when the depositors comes to ask for the deposit, you can't hand over commercial paper to them. You need to give them cash, which is not coming by. So we saw also Chinese home buyers, they are refusing to pay mortgage because the developers were not able to complete the projects. They are so far delayed on their projects. And meanwhile, those home buyers who have bought those apartments have their mortgages due, and they're like, we're not going to pay for it. So those kind of protests. Now, this is where was another little scary picture, that the military, there was tanks out in the street protecting the banks and prohibiting people, tanks and the military prohibiting people from reaching to the bank branch to withdraw their own money from the banks. So there is, and given the fact that the China's growth has slowed down, the picture doesn't look that great from a China perspective. So if you hold Chinese stocks, just be aware of it. I mean, I hold some of the Chinese stocks, but let's be aware of what's happening from China's economic perspective and what's some of this crisis going around in China. So recent news was, I think it was last week, regulators have stepped in. They're told that those customers, those who are deposited in 4 banks in Henan province, they will be able to take out some money, but not all. So I think there's a limit of 50,000 yuan. You can take out only up to 50,000 yuan, and not more than that. But among those 4 banks, they hold $1 billion of customer deposits. So yeah, situation is little scary out there. Now, this whole contagion around the whole property, if this spreads, it's not going to end well in China. I mean, property is a big market in China. Most of the Chinese investors have more money on the property side. That's their primary investment vehicle, and not the stock market. But given the fact around all the crises on the developers and what's happening on the property side, it's not going to end well. So just be aware on the China side. Sachin, how come not police or army but tanks? Yeah, I mean, they also had police out. I mean, I don't have all those pictures, but they had a police preventing people from entering. There were some images around police covered dragging people away. They were, I mean, all the people are there holding their signs and protesting, saying we want to withdraw and allow us to withdraw our savings. And then the bank called on police, which dragged them out. You know, you can do all those stuff. So yeah, not good. So that's all around the China side. It also gave me a little pause, maybe to relook at my own investments that I hold in Chinese stocks. I mean, I don't have too big an exposure, but I do have some exposure to Chinese stocks. So so any other questions? Can I talk about investment opportunities in India? I actually don't invest in India anymore. I used to be active on Indian stock market before I moved to US. And then after I moved, I wanted to focus only on the US side. So I don't have much idea around companies in India, how they're doing, who is doing what, and what's the current climate is. I'm sorry, I don't invest on the India side. Ross, countries anywhere not allowing council to draw their real money learn to their labor. Yeah, exactly. I mean, we blame a lot of crypto lending companies. I mean, we've seen this on the crypto side, right? Recently, almost all the lenders they froze withdrawals, starting with Celsius, then BlockFi, then Voyager, and whatnot. Many of those companies have declared bankruptcy, but then all we blamed was, hey, those are unregulated and new segment and all that. But who would think that it can happen to so-called banks, which is scary. Any thoughts on bonds or bond ETF in these times? So far, bonds really didn't play out. So in a short term, bonds get correlated with how the stock market is doing, especially when the market is in distress. But right now TLT looks to be attractive, I must say. You know, I used to be active on the TLT side, but I haven't. I mean, I sold off all my TLTs around 148 somewhere in November, etc., and I haven't gone back into it just because when there is a lot more distress in the market, even the bonds get sold off. So was it last week or a week prior to that, right? So that the traditional portfolio of stocks and bonds over a year or 2 years may not work out, but over a longer period of a time, it does work out. So if you want to look into the bonds, I only used to trade in TLT because the options are pretty liquid in this one. There is from a treasury, those inflation protected bonds, which are giving saving bonds, which are giving 9.6%. But be aware of the conditions around those bonds. That also is a possible. Another vehicle for investing in bond. These are the two that I'm aware of. Other thing, if you want to look for from an ETF perspective, you know, because these times are uncertain, we don't know where the market is going to go. Maybe look at high dividend players, right? So one such ETF, which actually I have used earlier also, is SCHD. It's a high dividend ETF with a dividend yield of close to 4%, which is decent enough. And it holds a big, you know, nice dividend paying companies in it. So SCHD Holdings. And also its expense ratio is not, you know, it's not superly expensive. It's like it's like but 0.06, right, which is way better than some of the other ETFs we see is around 0.7%. So from expense ratio side, it's good. So I looked at the others also, like there is another one, Dividend Aristocrat, called Noble, NOBL. Noble is again, it holds Dividend Aristocrats, it's good, but Noble doesn't, from options perspective, Nobles is not that great. So I basically focused on SCHD, right? So, and there were some decent holdings. Where is the holdings go to? Portfolio. What? Whoops. All right, who's their webmaster for this? They have to look at this JavaScript. Anyway, so they do hold, all some of those big, well-paying dividend companies. So for dividend play, won't oil companies be a better play than yield greater than 10%? Sometimes, see, at the end of a day, the dividend yield, the way we calculate dividend yield is share price divided by the amount of, dividend divided by the share price. That's our dividend yield, right? Now, it is 10%. It is because they are generating, good cash and able to pay great dividend, or is it because the share price has gone down? So I am little scared of anyone which is generating higher than 10%, right? Because what we also have to think is this dividend sustainable? If the business is not good and that's why the share price has got punished and hence the dividend yield has come up, then it means that they won't be able to sustain dividend for long. So when I do my dividend play, either if I'm doing individually, I would really pick the big companies, right? Pick anyone from a dividend, the big companies from Dividend Aristocrat list. So Dividend Aristocrat means they are known to increase their dividend for 25 years. To get into that club, you have to increase the dividend consistently for 25 years. So it means those companies have been around. They have been consistently able to increase their dividend. And, those are not the companies that could disappear. So otherwise, pick an ETF. That's how I play when it comes to the dividend. So, or the REITs could be good because they, again, return most of their earnings in form of, I don't know what's called as a dividend, or was it really dividend? But I think that's also is good. So QYLD, what is QYLD? QYLD. Oh, NASDAQ covered call ETF. So, okay. Yeah, but this gives you a lot more exposure onto NASDAQ, right? So yeah, so there are these options. I focus on SCHD. Other one I have is from my oil and gas exposure, I have AMLP, which is I think close to 9%. Again, that's a ETF. Now it's 5%. Right? Earlier, when it was trading around $25, $29, it was yield shows around 9%. Now it is 5.5%. Again, that gives me exposure to the oil plus decent dividend play for me. So those are a few ones which are available. I also focus on that it should, that they should have a decent option. Many of them probably won't have great depth in options, but okay, there is some way for me to continuously reduce the cost basis while I hold these shares to get dividend. So I look at the ones which has got some better from an option perspective, right? So NOBL, like I said, that's again, it's a dividend aristocrat, but their options are very wide. So that's why I don't invest in NOBL. So again, at the end of the day, we shouldn't have dividend is great. That's an icing, but also make sure our capital that we have invested is safe, right? That doesn't get eroded out. So trying to go for those higher yields, we shouldn't be buying into something that's a bad business. Early can also do out of money covered call on these ETFs. Yes. So let's say on AMLP and SCHD, that's why I do out of money covered call. So I think on AMLP right now I have a covered call at 38 and 39 for August expiration. All right, last thing is again a recent study from Trades to Trade around the cost of insurance. Right, there was, when we started, there was a question on, hey, why not buy a put? So I think I've seen multiple studies, but this is the one that came in last week. So it's got more recent data on buying put and how that would have performed. So overall, this market has been downtrend, no surprises. SPX is still down 20% from its previous high. New trade, now traders start to worry about a potential long-term bear market and the right strategy to hedge their against their portfolio. Right, different hedging techniques. There are many hedging techniques. One is to just sell everything and sit on cash. Right, if you're not in market can't hurt you, but then you get hurt by other stuff, which is inflation. Or you buy put, or you sell call, you sell call spreads, or you focus on the other instruments like volatility instruments. There are many ways to hedge your portfolio. So, but the easiest and the simplest is, let's buy put. So instead of selling calls, because selling call will provide you limited protection, traders look for more aggressive hedging strategies such as buying puts. Right, easy to explain, easy to understand. Mostly I see retail investors are, you'll see this happening most around retail investors. You know, if you join any of these trading chats or trading spaces, Twitter spaces, it will say there's a lot of talk around buying puts. But given their cost, does it make sense to long puts as a portfolio protection? Right. Only thing is, if you buy put and market crashes tomorrow, great, you're a genius. Right. But I don't know when the market gonna crash. And number two is, I don't know if it crashed once, will it not crash further? So we're looking for a hedging strategy that we can use forever. Not just today, but I want to have that hedging available forever. So the other one is long puts. So easy, and many investors do this, is to go and buy puts. So this is a data from they should have actually mentioned it, but because I watched this segment. So this from 2006 all the way till June 2022. So starting in 2006 means it also includes our great financial recession of 2007, 2008. That includes all the bull run. That also includes the crash of 2020. Then includes the spectacular reversal after the crash. Then it also includes the first half of this year, which has been downtrend. So it has gone through multiple cycles of ups and downs, right? And the strategy is just buying 16 delta put, right? 45 days to expiration, buy 16 delta put, right? And do that every expiration. Right? So buy 60 delta put starting in 2006, 45 days away from expiration. Once that expire, go ahead and buy another 16 delta put. So which means you're trying to protect your portfolio by buying 16 delta puts. Average P&L has been negative $38, of course, because the markets from 2006 now, has been on a longer period is still up. Median P&L is close to negative 91. Success rate only 6%. And the largest profit is $5,372. Doesn't if you are scared of the markets and have been buying $16 puts, you're actually lost because the puts were expensive. So really didn't work out. So how about if you're trying to manage it for 21 days to expiration, right? Going back to some of our previous discussions, why start to manage sooner to avoid the gamma risk on the last few days where the positions start to move much closer. You are able to increase your win rate as well as your average profit if you manage it before 21 days, and don't let your position go through those gamma risk. Did it perform better? Yeah, of course. Performed better than holding all the way to expiration. Average P&L was, instead of negative $38, it's better, it's negative $28. But the fact is that it is still negative, right? And so although the insurance did reduce the losses in 2008, if you look at these are the chart on white, is that they just have your S&P, no insurance. This yellow orangish is your you have SPY, plus you are buying 16 delta puts for protection, but you are managing it at 21 days to expiration. Blue is the one which you are holding your SPY portfolio, plus you are buying 16 delta put for protection, but you're not doing any management, letting the it go through all the way and then buying another 16 delta put, taking it all the way through expiration. So again, as it always happens when you go long in any kind of option, is if the markets immediately react to your direction, you make money. So 2008, it did help. But overall, considering all these corrections and the increase in the market, if you had not done anything, you would have still come out way better if you had just held on to SPY. Buying puts really didn't protect your portfolio over long term. Right now, we've gone through this cycle, 2008 crash. We also gone through this 2018 crash. We also gone through this 2020 crash in here. So over long-term perspective, and this is not the only, so this is one more came out last week, so I'm sharing it. But over long-term, purchasing insurance such as puts sounds excellent, but it isn't realistic because the cost of insuring is really high. So managing positions early can still improve, but still doesn't provide enough benefits in the long run. So the question that, I don't know, was it Dave who asked, why not buy puts? There's a reason why I don't buy puts. I've seen many studies which talks about how it just doesn't work over long term. So I rather focus on other ways to hedge my portfolio than buying puts. It's an easier stuff to do. The other stuff is little hard. You need to learn about it. It's an easier stuff to do. So people end up doing it, but it's not optimal for your portfolio over long term. But if I buy it put today and it crashes on Monday, goes on 10%, I will, you know, sound and seal, I'll seem like a genius, but you can't do it over a long term. Ramesh says it helps reduce the margin requirements and lower profit when selling out of money put. But when you're selling out of money put, it is still a bullish strategy, right? So if you're selling out of money put and buying a put, essentially you're creating a spread. That I don't consider it as a hedge. If you're selling a put and buying a further out of money put, it's still a bullish trade. So, but that's not a hedging trade. But yeah, but that's as a part of any Ramesh, again, as a part of any spread trade, if you go naked, your margin requirement will be higher. Convert it to a spread by buying a long leg. Yeah, I agree. But that's a different, your motive is different over there. Your motive is I'm bullish on this, but I'm, instead of selling a naked put, I'll sell a spread. But overall, you're still positive delta. It's not a hedge trade. So yeah, the only reason why I would buy these options is to, instead of doing naked, if I want to do spread, right, to contain the buying power. But for protection, generally for my, let's say, portfolio protection, buying put hasn't worked out. So I don't, that's the reason why I don't buy put. But that also means I can't come and claim I made 300% because I just got lucky the day I bought put and the stock had gone down, and I made 300% on it. I can't come and claim that as well. But that's fine. I'm not here to impress anyone. I'm here to make money. PSing, buying puts seems better than shorting the stock. You don't get margin call. Doesn't require any margin. Yeah. So shorting it. Okay. When you talk about shorting stock, yes, I agree with that. I agree on that perspective. Number one, not everyone can even short the stock, right? Some of the brokerages, depending on how much account you have, they may not even allow you to short the stock. But it is better than shorting the stock, but still not good enough for your portfolio. There are better mechanisms for portfolio protection. So I would rather use those than buying the puts, right? If it's not the worst, but that doesn't mean it's good enough for the portfolio. I have made a rule, never do naked and short sells. Yeah, I mean, I still do. Yeah, that depends on, you know, how comfortable you are in managing the risk. I think I still do naked option trades, but they depend on, you know, I won't do a naked calls on, let's say, maybe on individual stocks that I've decided I don't want to do it. Or on ETF, yeah, sure, I'll still do it. So I think it depends on each one of us, our account size. Number two, our risk appetite. Number three, how do, you know, if we know how to manage it or not. We will get scared. Let's say the moment your short strike is breached, I've seen, you know, people getting scared out of it and say, gosh, I'm gonna you know, take a loss and close my position because I have a naked call, and that's an you know, unlimited, potentially unlimited loss, right? But we should all, maybe next time we'll look at a study. So there is also a study I came across on Tasty Trade around, and again, that only considers SPY, is if you're selling you know, 16 delta naked calls and naked puts, even though theoretically you have unlimited losses, over a longer period of time, what's the probability of you know, large losses? So again, I'll have to find that document, but I think that I read a few weeks ago around the probability of incurring large losses. The reason why we get scared out of selling naked is theoretically it's an unlimited losses, but actually what's the probability of that? right? Especially, I mean, on the ETF like SPY. So that's a study. And if I recall correctly, the probability actually comes out to be, not the probability, but the actual the data for last 15-20 from 2006 onwards till 2022, it's 2%. There are only 2% of the times when you actually get into those large losses. But again, I'll have to find the study to share more details around it. But that 2%, when those will come, we never know. So yeah, it's better. I mean, why do you even take chances and lose sleep on it? Convert into a spread. Is there a better way to bet a stock will go down instead of selling call spreads? So, I mean, you could short the stock, but then you have your margin. I mean, these are the ways of expressing your bearish thesis on any stock, right? Short the stock, sell a call spread, buy a put spread. These 5 are all negative delta trades. Now you can decide which one you are comfortable with, which one you are allowed to do in your portfolio, and which one you are comfortable with. Or the other way is, if you are, you hold your stock, but then you can do, take a negative delta position on ETFs, etc. Which, for example, I do is I have a lot of tech stocks, so I'll go negative on NDX. But that's not 1:1. Yeah, Jay, thank you for adding the synthetic stock or synthetic short, which is a combination of basically going 100 delta, buying a put, and selling a call. These are the options available. I don't know, beyond that, what else can you do? You can just sell your stock and not get out of it. All right, I think that was the last one for today. Pretty much tapped out. Damn, this COVID makes you tired. Yes, it will be same as shorting it's a kind of a synthetic. It's called synthetic short because your delta is -100, but instead of having -100 shares in your portfolio, you have, I mean, if you're not allowed to short stock, this is a synthetic position you can take, which is, let's say, I want to short it till October. Buy this put 50 delta. Okay, let's do a close to 50 delta. Sell this call. That becomes my -100 delta position. Right. So from a same as short, the risk is same as shorting the stock. Yeah. I mean, it actually, from risk profile, everything else, it will just behave like you're shorting the stock. But instead of doing stock, you are creating that position using options. That is why it is synthetic short. And that's a beauty of options, right? We can express our opinion whichever way we want to. I am bearish, but I'm slightly bearish. Okay, we can construct it using options. I don't want to be 100% bearish. I can be only 50, sell 50 deltas, etc. So that's the beauty. Alrighty. All right, last few minutes. Any other questions? Anything else? Is the tool that you are using Thinkorswim? Yes. Yeah, I use I have two accounts where I trade options regularly. One is Thinkorswim. The other one I have is Tastyworks from Tasty Trade. Those are my two platforms for options. Cool. Any other interesting company came across? Wanna touch base upon?
We are working with a company called Curve, Kerv, but it is not listed. It will in the future probably. It's AI based. So what are your thoughts on AI companies? They're basically monetizing use of pixels and AI to see that when you're streaming video on YouTube, on Netflix, on TV, on Facebook, anywhere, you should be able to click or point your remote and do shopping at the same time. So, for example, there is a beer or there is a toy or there is something, a fashion thing that is done by a celebrity and you want to buy it, you click on it and it takes you to the shopping cart and you check out. So that's what Curve is doing.
Oh, so Walmart recently announced that, right? Walmart went up with partnership with whom? With Roku? If I recall, we talked about that. Inline shopping. Oh, Walmart. Roku.
I can put a link here. So
I forgot. I know. I mean, there are yeah, shoppable. Walmart and Roku partnered to buy shoppable ads. Yeah, I think this is what we had reviewed earlier. So Curve does something similar to this in terms of you can buy.
Yeah, we were part of the seed that we put about 6-7 years ago. So now they have been finally able to catch up with what their projections were. So this year they are going to do over 40 million. And this will be the first year. So next year they want to do it more exponentially better and then maybe sell or list on stock market.
Got it. Yeah, I mean, I'm not sure about AI right now, but the space is really attractive, which is buying on a streaming platform within the experience. I mean, you don't have to go out. Let's say if I'm watching something and I see an ad, today I have to go out or either take out another device or go to a browser or on a separate app to finish the shopping experience. So we are seeing the companies tying up and working to make this shopping experience seamless so that you're able to buy what you're watching on your streaming platform. So from that perspective, I think Curve is in the right sector. Now, when it comes to AI, and my general thoughts around the AI is, anytime I hear about any company saying making use of AI, I want to see one season or one cycle of a downtrend in the market before figuring out how great the AI has been, right? Same concern, not the concern, but I had the same questions on Upstart that uses AI to figure out the credit worthiness of consumers. All is great while the consumer is flushed with money and able to pay the loans back. But I want to see how great the Upstart AI model is in determining the risk factor and credit worthiness of consumers when the situation is actually not great for consumers, which is right now. Similarly, that's my general idea about anything from to AI is for you to train, to train the AI models, you need to basically have to have the data for and gone through one experience, one great and also one bad experience to figure out how great that model will work. And sometimes these models get corrupted, right? Recently, Unity Software, again, I hold it in my portfolio. Unity Software had to take $100 million of charge because their AI model was fed with the wrong data and was throwing up ads at the places which actually didn't result in revenue for their gamers. So now they are retraining their model, will take 2 quarters to actually fix their model. But I didn't look into the curve, etc. So I don't know about the individual specific company, but based on what you explained, looks like they're in the right segment, because I expect this segment to grow. Linear TV is becoming dead over a period of time. It will be more digital and more streaming. And now if there are companies who are building tools to allow shopping within that, it's going to be, it's going to increase over time. Whether it's going to be Curve because they got the best AI, or it's going to be someone else, that only time will tell. Sorry, long answer to your short question.
Oh, great.
Ramesh says, eTrade allows zero cost option below 10 cents to close. Not sure about Fidelity. I think even the TD Ameritrade does it below 5 cents. Fidelity is under 65 cents. You want to confirm that applies a part of a spread too, or do you have to leg out? Not sure what you mean by that. I mean, if you are doing a spread, those are considered as 2 legs, and you have to pay 65 cents plus 65 cents or whatever your per leg charge is. Those are considered 2 separate ones. Is there like a present? Thank you. You're most welcome. Thanks for the nice words. Ross, AI models will always be biased based on the developer architect rules and assumptions. I think initially, yeah, it will be based on whoever is developing it, but then we continuously have to feed them the data from the work, right? So that's the whole idea, that the model will learn, and overall their learning would overcome the initial biases. Let me put it that way. Closing is free on Fidelity. Under 65 cents. Oh, TDA is only 5 cents, only single. Oh, TDA is only 5 cents single leg. I thought it does for spread. Yeah. Clearly, I don't know exactly the pricing on TDA. Maybe an only single one then. Cool. All right. For those who are new, these contract pricing are negotiable. So don't settle with whatever the brokerage firms offer you to begin with. You can always negotiate it, increase our account size or increase our account activity, and call up the brokerage firm, talk to someone, say, I want to talk about reducing my per contract pricing. So way back I started at, I think, $1 or more than $1. Now I'm at 45 cents. I want to go further, but they are just not reducing more. I'm stuck at 45 cents with TD Ameritrade. I told them I'll bring in another 100K if you give me 35. I asked for 25 cents. I'll be happy with 35 cents, but they're just not budging. But yeah, these things are negotiable. See, Ali pays 35 cents. So no, I envy you. I want to negotiate. I'll be happy if I can get down to 35 cents. I think it's been more than a year since I last spoke to them. Well, that's fine. 45 cents. I'm happy with that. 25. Okay, I need to figure out what you did. Ali to stay at 25 cents. Maybe, I think last I spoke to whoever is TD Ameritrade will assign you a consultant or a representative, and then she used to call me 6 months. I told her I'll bring in, just negotiate the rates for me. But those are like 20. I think it's 2020. Probably they didn't care because there were a lot of new people came into investing, and I think these companies had a lot of new investors, and probably they didn't care about what the existing ones are thinking. Maybe now it's a time I should call them back and try to negotiate again. I didn't do that for, I think last discussion was 2020. Cool. All right, guys. Thanks a lot. And we'll talk again next week. Thank you for our time today. A break.
Thank you very much, Vivek. Can you give a little bit about you? I missed it.
Oh, okay. Okay. So yeah. So I work in. I work in a tech company. Our company is in data governance platform. Most of my life have been working in technology company, service company, product company, fintech, big data, and now most recently into data governance. That's what pays my bill. But I love investing. Been a retail investor for many years. Started dipping my toes into options almost 7 years ago, and I started this discussion because some of my friends, they knew I'm doing something around options, and in 2020 everyone wanted to go into options, so they asked me, can you talk about it? So I started doing this webinar or Zoom session with them. Then I thought, why limit it only to group of close family friends? So I started doing a meetup, and here we are. So we started with just talking about options. Now we start looking at, expanding the horizon to not just options, but general investing, do a deep dive into stock, do a deep dive into S1, and of course, option strategies and option boot camp. So for those who are new, I used to do a little bit boot camp also, but now my office job has become the load has become much higher. I don't have any time for boot camps. Yeah, and now I hear I'm probably gonna get one more department under me. So I'm like, gosh, I still want to do these Saturday sessions and find some time to prepare the content. I do talk about on Thursdays, focused on the crypto side. That's something which I might have to sacrifice if my day job becomes, if I do get another department and on my office work, so increase in responsibilities, so I have to find more time.
So there is a saying, Jidhar Hari Udhar Chari. That means where you see green, you want to keep that. Crypto is red, so you thinking of skipping that.
No, I will not. I mean, we still do crypto. We've been doing it even of course, when I was down with COVID, I'd skip that week. Otherwise, yeah, I do talk about it. Again, crypto is for next generation, right? So these things will come and go. It's not the first time. We saw that in 2017. We saw it in 2022. We'll probably see it again. But again, that's a wild, wild west. You have to be really very careful on what projects you are picking and putting money behind it, which projects you are putting money. But more importantly, to keep an eye, it's not going to go away. The tech is amazing. It will definitely change the way we operate. But minimum 10-year horizon or 15.
Web 3.0 is coming.
Yeah, right now I'm stuck in like 2.5. Yes.
Okay,
yeah.
Tell me how we can help you.
Yeah. I don't doubt that Web 3.0 will be here whether we want or not. So
Exactly.
either you get left behind. When internet was coming, I had no idea about it. I didn't have access to computer at that point of a time. So I was behind. It's only very late I realized the importance of internet. Now I'm fortunate enough to be in Silicon Valley. I don't want to make a dumb mistake of ignoring and shutting myself out. Yeah. So want to have open-minded and learn about it.
Tell us how we can help you.
Sorry?
Tell us how we can help you or your mission.
With all the discussions, right? So on a crypto side, so next week, we're going to talk about minor extractable value, MEV. I want to learn more about it. And we do have one or two people who are from a crypto industry. Come and talk about it. What you have learned, and we learn from each other. So
sure, I like that.
So yeah, so bring up a topics. If you can talk about some topics, even on this one, if you're saying, hey, I've researched this company, want to talk about it, do let me know. Send me a meetup message. It shouldn't only be me talking about it. I want to make it more interactive. But yeah, someone needs to put up effort and say, hey, I want to talk about these things. Sure.
So how do we coordinate? Because I just had received from my friend who's on the call, Tariq. Tariq sent me this link. So he might know more about you, but I didn't know anything about you until a few minutes ago. Ali Tariq, he's on the line.
Okay. Yeah. Ali is there. Yeah. So you can reach out to me and send a message to the meetup.
Oh, okay.
You just got the link. I don't know so from where Ali got the link. So let me just bring up the meetup group. So yeah, this is the meetup group which I started in 2020 when I started doing.
Are you texting, chatting, or where are you putting that? I'm trying to look in the chat. I thought you were putting in the chat.
Oh, sorry.
You put it in the screen? Oh,
Yeah. So
okay.
this is. Oh, you see this?
Okay, now I'm seeing the screen.
Yeah,
Sorry.
This is the meetup group. So if you're attending this, if I cancel the event, I'll basically come and cancel it here.
Oh,
Yeah. So if I'm generally in the morning, I'll come and update, what the topic is. For example, this one I canceled it. So you can send me a message to the meetup and.
okay, good. So I go. Okay. All right. I got it.
Cool.
Very good. Thank you so much, Vivek. It was great hearing your relaxed approach to a serious topic.
So, I mean, for me, the reason why I want to investing is this is something which I want to do once I'm done with my day job, and I don't want it to overwhelm me. I mean, if it is gonna the way I invest is that I don't want to lose my sleep.
Correct.
Plain and simple. So I don't
Yep.
want to make any bets even though I've been selling options. I don't want to go to an extent where I have to worry about margin calls.
No naked calls.
Yeah, so protect yourself. So I've been
Yep.
through 2018 crash. I've been through 2020 crash. Yeah. After I started doing the selling option, I've been to 2 crashes, but thankfully no margin calls. Sleep.
Okay. But if you don't mind me asking, how's your portfolio doing during this April to July timeframe, last 2 months?
So from longs are obviously challenged. But like I said, the options premium and so basically all the option trades have been really great. So if I just look at the option premium that I have been able to get, if the market had just stayed where it was at the start of a year, and I don't look at like 3 months, I only look at my like year to date, how much option premium I have collected. I have collected almost 1/3 of my portfolio value. At the start of year, I have collected that much in option premium. It means if the market had just stayed where it was, could have been up 30%. But my long positions have been a lot underwater. But that's okay. I'm reducing my cost basis by collecting options. By collecting option premium. So, so my focus is still long-term investing, but I use options to reduce my cost basis or buy shares cheaper. Right?
Mhm.
I don't want to do a lottery tickets on options. I work a little differently.
No, that is the best and right way. It should be a hedge. It should be a risk mitigation tool rather than a speculation and a casino. It's already a casino with a lot of algo, this, that happening. And then you jump in there, it's going to blow you. I mean, you might make once or twice, but one, a mistake and you're gone.
Yep. Best thing I learned is the longevity is most important thing in the market, because market generally anyway has a trend. If you, as long as you are alive in the market, there are ways to make money. So don't go crazy and taking the bets that just shuts you out of the market. So
Correct.
I mean,
Wow.
focus for the long term.
Yeah.
Cool.
Thank you very much, Vivek. It's been a pleasure hearing from you.
Thanks. And thanks for participating. It's great to hear from you as well. All right, guys, let's talk again next week.
All right.
Cool.
Same time next week.
Yep, same time, 10 o'clock. If it cancels, I'll send a cancellation or a meetup.
And is that the same link?
if I haven't signed on the meetup, then that's the reason why I should sign on meetup, because if I'm not attending it or not able to do it, I'll just cancel on the meetup to
Okay,
get a
got it.
notification.
I'll do that, Ron.
Cool.
Thank you very much.
Thanks, Sarah.